So nice to see so many people at Imperial. I've been heard that how nice it is for already seasoned professionals to be back on campus. It takes them back in memories to their student days. So I hope you enjoy some part of it as well. So we have a very exciting topic here today and a very exciting panel. Carbon accounting and the pursuit of climate targets. It's a very well rehearsed phrase that what cannot be measured cannot be managed. But are we measuring the right thing? Are we managing the right thing? Is the questions for this panel. I assume that nobody needs to introduction here to carbon accounting, scope 1, 2, 3 emissions, but I'll just mention just in case. Scope 1 emissions are own emissions from the corporate production or operations. Scope 2 emissions from electricity that the company uses, and scope 3 emissions is supply chain emissions. Particularly very interesting category to me of scope 3 emissions is category 15. It's the financed emissions, or emissions of financing portfolios and operations. And this is something which we at CCFI, the Center for Climate Finance and Investment, also look at. We just released recently, a few months ago, a paper on carbon accounting for commodity derivatives, where we lay the groundwork for why we need to account for carbon emissions on derivatives, which by themselves do not represent a direct ownership and often do not lead to direct emissions. Very often, the oil options traders do not burn that oil in any shape or form. So we build the foundation, but a lot of more work needs to be done on methodologies. There are two main bodies which pretty much set the standards for how we account for emissions. One is Greenhouse Gas Protocol, which is mostly used for the production companies. And then there's the PCAF, Partnership for Carbon Accounting Financials, correct? Which sets the standards of how we account for financed emissions. They're quite, PCAF standard is not a kind of a rule, and it's still in development. There, from our conversations with various financial institutions, some of them do not like certain aspects of that and therefore use their own rules, which makes the emissions not directly comparable between different financial institutions. There are also some interesting shortcomings or gaps in the methodologies, or some of the panelists may say it's maybe intentional, right? PCAF does not have a methodology in how to calculate emissions on the derivative instruments. PCAF uses EV, enterprise value including cash, as a denominator, which can lead to a lot of volatility due to the market volatility and market cap volatility especially. PCAF does not address any long-short positions and how they can be treated. PCAF does not address the issue of tenor and holding period. For example, a bond of an oil-producing company, 1-year bond versus 40-year bond, in any 1 year of holding will create the same emissions for the corporation, though the greenhouse gas warming potential of that bond may be quite different. So we're not going to address all of it, but I hope we will shed some light on some gaps and maybe, hopefully, potential solutions. So let me introduce our panel. We have Alex Lake from S&P Sustainable One, Simone Cenci from UCL, and Adam Hearne from CarbonChain. Alex, would you like to tell about what you do and where you come from and what's your expertise?
Sure, yeah, so I joined actually TrueCost, which is a sort of environmental research company, back in 2016, just as it was being acquired by S&P. And since then, I guess I've been a sort of long-time practitioner of carbon footprinting for portfolios. So I've always been on the financial institution side. So for a long time, we were doing carbon footprinting, environmental footprinting across a range of different metrics. And then more recently, the work has spread into TCFD alignment, looking at transition risks, physical risks, and of course regulatory alignment to things like the SFDR or the EU taxonomy. So yeah, my work has been about trying to design these products based on data sets that S&P has been creating in order to help financial market participants in their decarbonization journey.
Sounds great. Simone?
Yeah, I'm Simone Cenci. I'm a lecturer in economics and finance of sustainability at the UCL Institute for Sustainable Resources. I was actually here before moving to UCL, so it's quite nice to be back on campus. In my research, basically, I try to understand what companies are doing to lower the environmental impact, mostly focused on the climate space, so to lower their emissions. Try to understand what is the impact of the different sustainability choices and what drive their decision-making processes. So when you think about the impact of the choices, it's very important that we have the right tools to measure what this impact means. So carbon accounting is part of the research I do.
Thank you. And Adam?
G'day everyone, CEO and co-founder of CarbonChain. We help companies in the manufacturing and commodities sectors track their emissions, and these sectors represent a majority of the world's emissions. We help them get interest rate discounts from trade finance banks and meet their carbon reporting requirements.
That's absolutely great, very interesting. So Alex, let me start with you. Given that PCAF already set quite a lot of standards on how to calculate, what would you say are the biggest challenges that financial institutions are facing now in calculating financed emissions?
Yeah, I mean, I'd be remiss not to say that obviously S&P has obviously become a founding data partner with PCAF as well. That was announced in February, so we're working very closely with them to make sure that financial market participants can do their PCAF-aligned reporting. The challenges, there's a lot of challenges, obviously, but like if we were to focus on three different areas, one of them would be data quality. I'm sure everybody in this position that's been asked this question will mention data quality as a possible challenge. This, obviously, it depends which asset class you're focusing on. If it's corporates, then, you know, Scope 1 and 2 emissions disclosures are pretty good, depending on region, obviously, and you know, the maturity of those disclosure markets. But Scope 3 can be challenging and spotty, and coverage can be sometimes different depending on who's reporting it. Methodologies are still sometimes quite different. So if you're trying to track changes year on year, that is a challenging scope to cover adequately. But the data issues also aren't just on the carbon side, they're also on the data side. They're not just on the listed company side, they're on the private company side. So PE, loan books are obviously PE is becoming a larger part of people's investment portfolios. And without disclosures, people rely on industry estimates or sector-based estimates, emissions factors. It's useful to get full portfolio coverage that way, but it's not going to help you identify like leaders or laggards within those industries. And also when you're trying to pull in financials to do the apportioning for private companies, the disclosures on the EVIC metrics, for example, the balance sheet items can be very lagging or delayed or spotty or sometimes not that consistent when it comes to SMEs. So that can be a challenge on the data side. Getting multi-asset class coverage is a challenge. So everybody's interested in covering as much of their portfolio as possible, but there are lots of challenges on the different types of asset classes you might want to focus on. So even for methodologies where there is something available, so for corporates, the financial sector is very good at cutting up obligations and creating like collateralized instruments like CLOs or mortgage-backed securities. So even if there is a methodology for lending to corporates, if you have an instrument that is very hard to trace the provenance of, or you don't have a look through, it's very difficult to do footprinting. And then other asset classes like derivatives or sovereign accounting. PCAF has done a great job at covering lots of these with available methodologies, but the way the actions that you would take from each of those financial emissions outputs might be different based on what the asset class is. So it's quite hard to navigate. And then the last thing about that, it would be the third challenge would be about what to actually do with your financial emissions calculations. How do you interpret it, and how do you take action? Should you set targets? Do you open yourself up to litigation if that's the situation? Do you report in a gung-ho manner if you see carbon finance emissions reductions which aren't actually due to anything you've done or real-world emissions? No, you should pause, but I'm sure we'll come back to that point.
We absolutely will come back to that, but let me go to Simone first. And obviously, financed emissions would be very much reliant on getting the Scope 1 emissions of non-financial corporations right. Are there any problems with greenhouse gas protocol methods? Any particular issues that you can highlight?
Well, I want to second what Alex just said, that the greenhouse gas protocol is is roughly good. There are problems. There's always going to be a problem with any protocol we come up with. Scope 1 emission and Scope 2 emission are typically fairly good. The problems lies, as everyone knows, with Scope 3 emissions, and there are many reasons why that is challenging. It's an objectively challenging task to measure the Scope 3 emission of your sole product, your upstream, your downstream, your supply chain, and so on and so forth. But that being said, the greenhouse gas protocol has also been continually updated, and we're now waiting for the latest update, in fact. And one of the problems that you have in Scope 3, as I was saying, is a sort of a lack of harmonization. So there are different ways to calculate Scope 3 emissions. So what does that mean when you're going to compare the Scope 3 emission of different companies? We also need to know how they come up with the number. And this lack of harmonization within the protocol is actually probably one of the biggest problems of the protocol itself, also when it comes to the problem of non-CO2 gases.
I understand that's actually your specialty, non-CO2
Well, it's not necessarily my
gases.
specialty, but it's something that I look at. And because that's not something that people typically look at, maybe it's good to give a bit of context. And we saw before as well,
You have the graph if you want.
Yeah, thanks. CO2 emissions are very important to meet climate target. That by far the most important gas, carbon dioxide. In fact, based on the latest IPCC assessment report, carbon dioxide is responsible for approximately 0.8 degree of warming. But methane, which is the second most important greenhouse gas, that is responsible for about 0.5 degree of warming. And that is fairly comparable to the warming of CO2. So now, obviously, we have much more CO2 in the atmosphere than we have methane or other non-CO2 gases. So why they're so important is because per molecule, they absorb much more heat over a given period of time than carbon dioxide. For example, taking methane again, over 100 years, methane absorbs about 28 times the amount of heat that the carbon dioxide absorbs. What that means is that the global warming potential, GWP, of methane is 28. And this is how in the greenhouse gas protocol, companies calculate the greenhouse gas emissions. They take all the carbon dioxide, then they take each non-CO2 gas, they multiply it for the GWP, so the global warming potential, over a given time period, say 100 years, and then they get their CO2 equivalent measure of that gas, and then they sum them up. Okay? A lack of harmonization comes from the fact that while they're supposed by the greenhouse gas protocol to use the latest GWP 100, so GWP over 100 years from the latest assessment report, they don't have to do it. So there is an optionality within the greenhouse gas protocol, and what that means is that basically company can use whatever GWP they want. And if you look at effectively what they do, the solid line that you see there is the GWP of methane. Look at the GWP 100 over there, and the dotted line shows the average GWP used by approximately 2,000 companies, like typically large company, about like 50% of total market cap. So it's not just that the two don't overlap, but if you look at each of those points, there is a variance around it. So it's not that just everyone used something else. It's that everyone used different things. So if you used to think about it in financial terms, it's like you want to compare the revenue of a French, an Australian, an American company, US dollar, but everyone uses the exchange rate that they want, and how do you compare the revenue? And this is because there is an optionality built within the greenhouse gas protocol, so lack of harmonization just as in Scope 3. So that is one of the problems of the greenhouse gas protocol, particularly the problem that relates to non-CO2 gases.
Thank you very much. And it also kind of reinforces what Jim Skier said, that of the importance of reducing the methane emissions.
Yeah.
If we don't have the unified methodology, that's a problem.
Exactly, and there is a task for short-lived climate forces, right, for 2027. So this is a well-known problem.
Okay, sounds very interesting. Thank you very much. Now let's make a step back and go to Adam. CarbonChain actually sounds like you're doing something with Scope 3 emissions. What are the challenges of the Scope 3 emissions calculations? And what are the advantages?
The challenges and advantages. we're seeing some advantages, but the challenge is still in the data collection, as we mentioned, and will probably be a theme of the day. And it manifests itself in our business. So we very much look at the physical supply chains. So we appreciate there's derivatives out there, but in order for us to get very good views of the actual emissions and the assets, we have to go to the primary data source. And so we look at the physical supply chain. So the challenges there is getting visibility on your supply chain, which is hard enough on its own. Now imagine trying to put a carbon tracking layer on top of that. You've almost got an impossible supply chain challenge. So we see a lot of companies trying to get to grips with engaging those suppliers and speaking to their tier 1, tier 2, tier 3 suppliers. Companies that are slightly larger have a bit more power in their supply chain to get that visibility. Smaller companies, on the other hand, don't have as much leverage. So that creates a lot of issues. And then I think another challenge in this space is beyond harmonization, it's actually knowing that carbon tracking is here to stay. It's not just a fashion trend. A lot of companies are underestimating how much they need to invest in terms of internal teams, internal experts. I've got some experts from CarbonChain here today just enjoying the conference, but they spend a lot of time trying to educate these companies and their sustainability departments to upskill them and help them get their own carbon decarbonization strategies in place. And we're also hiring, if I could just throw it out there, quick plug for CarbonChain, looking for carbon emissions experts to bolster the team because there's so much demand for just understanding your Scope 3 emissions. So once a company can get to grips with those challenges, just tracking supply chains and getting internal skills in place, we find that that's enough to help them overcome the challenges that carbon tracking would present, I guess. With all the methodologies out there, the different standards, if you've got visibility on your supply chain, you've gone a long way, almost most of the way, to finally reporting your carbon inventory.
Sounds great. You also mentioned that you help the companies get cheaper financing. Tell us more about that.
So this is an incredible start for a startup that was focused on wanting to solve, hopefully everyone hears me as the mic's dropping in and out. So we're working with the commodity sector, so imagine oil and gas and metals and minerals, trying to convince those sectors to measure their optional emissions, Scope 3 emissions, 5 years ago when the company started. At the time though, European banks were offering interest rate discounts to companies that would start measuring their emissions and wanting to decarbonize. So we were the first to really uncover this market dynamic change, and now we work with some of the world's largest commodities traders, helping them take part in this carbon transparent economy which is now emerging. Europe is obviously a big catalyst to this. You see regulation like the European Carbon Border Adjustment Mechanism, fondly known as CBAM, that's now live. Fines are coming out this year if you don't have your disclosures, and there are other risks for non-compliance, as well as social risk for just not being a good participant on a mandatory regulation. So that's changing the dynamic a lot. And for us, in order to get traction in this very difficult space, it was thanks to the role of finance in incentivizing the emissions reductions. All right, should I kill the lapel one as well? All right, thanks team. I'm back on comms properly. Hopefully that answers that question.
No, that's very interesting. Thank you very much. Another question I have, actually more for Alex, is are financed emissions the right, so kind of moving away from measurement into management, are financed emissions the right metric to track progress to net zero?
Yeah, I mean, so maybe just a very quick summary of like what financed emissions is. So, I mean, PCAF has got 3 strands of research for how they want emissions accounting to happen for different activities. One of the more recent ones are insured emissions and facilitated emissions, but it began with financed emissions. And financed emissions is built on the principle of, you know, if you are providing equity, debt, or loans, so some form of financing to an entity, then some of the emissions or impacts of that entity can be attributed to you, whether it's a sovereign or a project or a corporate. And for corporates, the denominator that's used, so if you take your investment value, whether it's equity, debt, or loans, the denominator used is EVIC, enterprise value including cash, which has certain challenges around volatility and availability in some cases, especially in private markets. But if you believe that this sort of attribution is a fair and principled approach, then there is a role for it. Is it the one only and best metric to use for a challenge like climate change and decarbonizing the economy? I'd say no. Obviously, there's no one metric to rule them all or anything like that. But it's certainly a useful one. I mean, we've recently come up with a target setting product for portfolio managers at S&P, and we've tried to be informed by 3 different third-party initiatives that have been sort of put forward by the PAII, the Net Zero Asset Owners Alliance, and by SBTI. And obviously right now there's quite a broad range of different approaches that you can take, including focusing on engagement, focusing on finance emissions reductions, or focus on coverage changes in companies that are aligned to net zero. So in the product, we ended up having 5 different approaches that you might want to take depending on what sort of portfolio you have. Those are portfolio coverage, which doesn't involve finance emissions calculations. You're looking just at the alignment or progress towards a net zero pathway of the companies you invest in and exposure to those companies. The second is portfolio decarbonization, which does involve calculating finance emissions over time, which has its own challenges. The third is sector-specific production intensity targets at the portfolio level. So when there are emissions reduction pathways for high-impact sectors like steel or airlines or power generation, we try to use that as one of the metrics that you're dividing your emissions by to understand whether your investees are on the right pathway. The fourth one is the temperature alignment, which again uses financed emissions in our calculations, and the fifth one is technology phase out, so which doesn't involve finance emissions. So there's a broad that's basically looking at coal investments, for example. If you decide that technology doesn't have a place in the future, you can choose to set a target around descaling your exposure to that without using financed emissions. So yeah, there's a range of options you might want to take, and it's applicable for some, less applicable for others. Happy to talk about the challenges if you want to dwell on that, but
sounds good.
Yeah. So the second one, the portfolio decarbonization targets, which do involve calculating your finance emissions year on year, setting a target, short term and long term for that, involve all sorts of difficulties. So, for example, the way that we do it, it's best applied to globally diversified portfolios. It might be because we use the global emissions trajectory of the entire economy as the pathway that everybody should be taking. So it uses the principle of what's right for the planet is right for a portfolio too, if it's a globally diversified portfolio. However, when you do that, your starting point is very important. So you take how many emissions there are in a base year like 2019, and you work out what needs to happen towards 2030, and you set your target based on that. But if the global trajectory doesn't, if it fails to decarbonize, should you just continue on your original path, or should you rebaseline your emissions each year? Should you pick up the slack when the rest of the economy is not decarbonizing? It's a difficult challenge to make a decision about and to communicate to stakeholders.
No, that sounds very interesting. And obviously, emissions of any scope are used widely for target setting, right? And tracking the progress. There's IAGCC issued some guidance where they were trying to emphasize the financing reduced emissions rather than reducing financed emissions, because there's a lot of manipulation can potentially go in any of this management of the one number.
Yeah, I mean, so that sounds like the target that's put forward by these third-party initiatives around climate solutions. So you should be setting targets around investments in climate solutions as well, which I guess is the financing reduced emissions.
Yes.
You're alluding to.
Adam, do you see a request for other metrics other than just emissions from your clients?
There's so much you could measure, and we know that there's like an E, S, and a G, but we do obsess over the E at CarbonChain, and we almost go as far as thinking it stands for emissions, not environment. So we thought we'd just pick a couple of things and try to do them really well. And in doing that, we have noticed we can get a lot of leverage and wins for CFOs in their business, or other leaders, executives trying to tackle an ambitious decarbonisation strategy, by giving them a financial outcome to prove that it is commercially viable to think of an aggressive decarbonisation strategy. So that's the main metric we try to push, and that is mainly underpinned on carbon intensity. So of a given functional unit, we try to look at that, and also in a way that in a functional unit that makes sense for that sector. But we're also dealing with the challenge of just because you're reducing intensity doesn't mean you're reducing absolute emissions. So a longer term challenge for us as a business is trying to make sure we're future-proofing our customers' strategy by keeping a couple of metrics ahead of where they're trying to be, so that we're always giving them the right tools. Because as we've discussed here, the tools and the methodologies can be so varied, but if you can just get the foundations right, you effectively have a Rosetta Stone, for lack of a better analogy, of trying to see how you can match from one standard to the next so that you can keep on going with your strategy.
Okay, sounds great. One last question before we open it to the audience. If we get the emission calculation right, do you think we need to switch from carbon emissions or emission intensity targets to carbon budget targets? It's a question to all of you. Who wants to start?
Yeah, I mean, there's a place for both. I mean, the reason carbon intensity metrics were introduced in the first place, like carbon to revenue or carbon to value invested, was to make portfolios comparable that were of different sizes. If you're just looking at financed emissions, the size of your portfolio obviously will determine the size of your footprint. I think the consensus among the most active sort of third-party initiatives is that targets should be around the financed emissions, the absolute number, rather than the intensity number. But there is still a role, obviously, for identifying sort of leaders and laggards within industries, for example, to use those other intensity terms. And we've talked actually a little bit about, even with financed emissions, that there can be fluctuations based only on changes in market values of equity, for example. So is that the right one to track your absolute emissions over time? And I think it is still defensible because it's not too difficult to do decomposition analysis of what is driving your footprint year on year. So yes, if you're heavily invested in oil and gas and they have a bumper year and the equity investors suddenly are responsible for a lot more of the company's financed emissions than the bank lenders, as a bank, you could just announce a reduction in your financed emissions without any further context, or you could do decomposition analysis and say, well, it's reduced, but this is the reason it could go back up again next year, and add context to what you're seeing in the financed emissions reduction. So, yeah, everything requires context, I think.
Yeah, and if I can follow up on that, I mean, also following what Will said before, we're talking about biodiversity, there isn't one single measure for biodiversity, and that's the same for emissions, right? It's easier, it's objectively easier, but even here there isn't one single measure. So yes, we should keep track of different targets, but on top of that, I think there is growing consensus that it's not just about the target the company set, but also actually see the decarbonization plan and try to understand whether those targets are actually feasible or not. And that is something that is becoming more and more important. It's more complicated because obviously the data structure is much more complex. It requires much more expert knowledge because each sector, each subsector has its own idiosyncrasies, but there is a very important component of when we talk about emission target that is being so far too much overlooked.
Thank you.
Yeah, from our perspective, and if we're thinking about ourselves more on the front lines of physical commodities trading and manufacturing, ideally we would have global carbon budgets and we would have country level breakdowns and we could go for that level of granularity. What we've found most effective is, given that we deal with steel, aluminium, oil and gas, the sector-based target is often quite powerful because you're unifying a bunch of domain experts in an industry that they know well, and they know the trade-offs that they need to take in order to start to set a budget. And so at a foundational level, we just want to see broader carbon transparency so that these sectors are equally able to work within themselves. And then longer term, once you imagine we've got better transparency of carbon information and everyone can speak the methodology and the language of carbon accounting, then we would see a middle ground as going to picking a carbon budget for your sector. And we've noticed a few sectors that are naturally decarbonising, where if you look at aluminium, for example, 90% of their cost is linked to the electricity grid that they're connecting to. So as grids are decarbonising, the aluminium sector is starting to get a very good transition pathway out there and being responsible for just under 4% of the world's emissions. It's quite a significant sector to talk about, and they can start to make it a differentiator. So there's a transition story there for metals, oil and gas. Not such a good transition story, but metals, if you can get that methodology out there, then you can start to work with broader stakeholders to accelerate it even further.
Sounds great. Thank you very much.
Actually, there was one other point I was going to make, sorry, about whether you choose finance emissions or intensity reduction targets. Another kind of less spoken about challenge here is, even if you do choose, whichever one of those you choose, it's difficult for like large institutional investors sometimes to take strong positive action towards actually reducing those because of the ever-present fear of tracking error. And there needs to be something done with, I guess, indices or benchmarking to make it more justifiable and palatable for those investors to take the actions that they need.
Thank you. Sounds great. Okay, now it's time we open to the audience questions. I see the first hand there.
I guess when you're talking about the supply chain problem and how that contributes to the company's carbon footprint, you alluded to the fact that there's a limitation on the data and you're working hard to improve the availability of data. The other problem there, of course, is physical risk exposure that the supply chain represents. Are you beginning to think about using the data in that capacity as well? Of course, there's slightly different reporting required there.
And I take it this is a question for CarbonChain? Thank you. So it's a good call out to make. We're firmly embedded in the transition risk side of that equation, but because we've had to link back to physical assets in our underlying calculations, we do provide provenance or a chain of custody. So now someone who's auditing their emissions can start to see what those physical risks might be. So a plant in India versus Sweden might have a different power security element there, and other environmental factors too playing a role, but we can't get into physical risk ourselves just because it's another depth of analysis, and we've had to stick with transition. But maybe I can defer to some of my colleagues that look at physical risk a bit more.
Yeah, I mean, so S&P does have physical risk analyses available at the portfolio level and at the non-financial corporate level. The physical risk data set covers 20,000 companies, so for investors, we're able to do physical risk analyses with asset level data, but it's for the direct investees, it's not for the supply chain yet. I mean, if there was a way of us sort of tracing the relationships a bit better, perhaps I think supply chain physical risk is something that we could work on, but right now it's about direct investments only. If you are an NFC and you know the location of all your supply chain company assets, and you come to us for a non-financial corporate analysis, then you can use tools like Climanomics to generate the same physical risk assessments on your supply chain portfolio. But that's, like I said, not at the portfolio level, that's at the individual company level who knows that information about their supply chain, knows the location data of their supply chain.
Thank you. There's a hand over there.
Thank you very much. Good morning. I'm Arietta and I work at Guidehouse as a sustainability consultant, but I'm also part of PCAF. So I think I'm kind of responsible for maybe give more transparency and try and save maybe PCAF's reputation. But PCAF is an industry-led partnership, and therefore as any respectable institution, organization, or partnership, there's always limits in terms of fundings and resources. So yes, as I think I noted down, Alex mentioned before, we just released guidance for the insurance-associated emissions, and then within the other guidance we developed, there's more and more assets and asset classes covered. But of course, this is a work in progress, and we try and develop more and more. But maybe one thing that I'd like to highlight is that being an industry-led initiative means that we also kind of need support from the industry, and in this sense, from the financial sector. And I also think that PCAF is great in terms of removing that level of competition among financial institutions, because we're here for the same goal of saving this planet and making the emission problem more transparent. So one thing that I think is an issue, and it's a problem for everybody, is also data and having high quality data available. And specifically within that, I think one of the best opportunities would be to have support from financial sector and financial institutions to kind of find a way to get the higher quality of data, because eventually they are the closest to their portfolio companies and to their investees. Maybe I would like to hear from you what your perspective is, or if there's any person here that is from a financial institution, happy to connect later. But I think one of the solutions could also be, in the client engagement process, to ask directly to your potential future clients or engage with your current one and say, hey, we're here all together. You have access to your energy consumption figures. You have access to everything within your company. Let's get this done and let's share your information, because it's not sensible, and this can potentially be shared across financial institutions who share the same client and kind of progress in that sense and in the data gathering process. So happy to hear if you have any thoughts on that, or yes.
Yeah, we could definitely collaborate on that, because working with the banks takes a long time to get going, but I can honestly say from learnings, and my team here as well have come across this, when the banks ask for the emissions, a lot of these companies are willing to give it. And it sounds very simple, but it's quite a diplomatic standoff sometimes when we're dealing with billions of dollars worth, hundreds of billions of dollars worth of lending, and you're going to put that commercial relationship potentially at risk by asking for full disclosure. But it happens, and we just wish more banks would do that. And so we could connect and talk about the European banking landscape, because they need to do it as a matter of compliance to their European Central Bank requirements.
Yeah, I was going to say basically the same thing, that the challenge is with SMEs largely rather than listed companies, and banks are in a very good position to, encourage or even enforce this sort of disclosure. But then also there's the challenge of not letting it stay just on the balance, like on an Excel sheet of a particular bank, but actually become more broadly available to others. So, yeah,
if I could follow up on that. So there's one thing which is convincing the company that it's good to know what your emissions are, and then it's another thing to getting them to disclose. So especially in oil and gas, where some of the supply chains are blended and the origins can be quite hard to disclose, then if you get the emission factors, you're also exposing them to a lot more risk, sanctions risk, just to name one. And so it's about finding that balance between knowing you've got a good, robust accounting methodology in place, but sharing just enough to meet the carbon battle. And that's where a third party is useful, like agnostic to platforms here today. I think a lot of corporates could take that away from the discussion today, which is it is helpful to have a third party helping you do this, just because you want to have your emissions almost in an escrow viewable manner to be compatible with future norms of society for disclosing.
Thank you. There's a lot of gentlemen over there who will be on my next panel.
Thank you very much. I would have a question for you, Adam, but please, other panelists, if you want to add something, of course, super interesting. So you mentioned that some banks were, some year ago, offering cheaper or better financing to firms if they disclosed and decarbonized. Could you shed a bit more light on this? As in, are they still doing this? What products are they doing this on? What are the orders of magnitude? Are we talking a few basis points or more? And maybe also, why are they doing this? Do they really see less risk in the firms that do it? Or is it more a kind of a, signaling, greenwashing kind of thing?
Yeah, let's cut straight to the point. So we asked ourselves this a lot, and we're trying to dig into it. So we found roughly a trend around 5 to 10 basis points, which doesn't sound like that much, but when you're thinking of a $10 billion facility, you can kind of get to the millions mark, low millions, if your utilization is really high. And then we were trying to figure out why are they doing this, and it turns out for the bank lending, the cost of their disclosure to the European Central Bank, I think there was a study saying it's $1 million or so upwards per banking business unit. So if they're getting their clients to do this calculation for them, they're effectively just saving costs. So for the bank, it's economically viable to try to outsource the job in very straight terms, and then they were passing that on. And now that the clients got going, so I think they offered the discount early on just to get everybody going. But now we see that actually being redacted a little bit, and the banks are trying to say that, well, this is how we do business now. And they tend to get better customer service, bigger lines of credit, but to actually offer the financial incentive is a little bit rare these days. Or if I'm on a panel with those banks, which I will be next week, we have to be very measured about how we say interest rate discounts for everybody, because they're still trying to enforce this point about being part of business in future.
Thank you. Here and then there.
Hi, my name is Athanasios. Very nice to meet you all, and thank you for today's discussion. I just want to make a quick question about the carbon accounting methodology of how you measure and how you place the organizational boundaries. You all spoke about like scope 3 emissions, and I think that's brilliant, and that's the major challenge. But how do you sometimes set up like on the carbon accounting method? Because I know it's quite difficult from the greenhouse gas protocol to start placing what does that mean? Because scope 3 emissions sometimes means scope 1 and scope 2 for other organizations within the supply chain. So how do you manage to start like understanding between the tier 1, tier 2 and tier 3, and where do you stop that? Where do you start, where do you stop, and how do you manage that? Because it's very, very difficult to do that. And I know there are two approaches about the two control approach and the equity approach, but how do you manage that so you can start making that like quite transparent for the organizations, so it can be quite easy to measure?
Yeah, thank you. I'll jump in quickly because we've spent a lot of time doing this. So we start at the cradle, so our boundaries are cradle to gate or cradle to grave. And the reason we can do that is a lot of the people at CarbonChain have a commodities background or are exposed to commodities. So for myself, I was at Rio Tinto for 12 years, literally working in some of the mines, coal mines, copper mines, gold mines, diamond mines, which was probably the only time my wife sincerely asked, how's my day at work, which is when I'd come back from the diamond mines and go to Antwerp. But it was giving us a profound respect for knowing that the cradle is the ultimate boundary, like Mother Nature, the ultimate stakeholder there. And so we then move forward. And so the reason why we have to really own the fact that we just work with commodities and manufacturing is because it's quite hard when you go down the chain. And so we thought, what's a different approach we can take in this space? We'll start from the cradle and then work down to the tough stuff. Whereas we notice, and probably a lot of panels in this room will talk about how hard it is to go back the other way from like an iPhone and back up the supply chain. You kind of take 2 steps and it's just really hard. And so we're working our way down the other way, which just helps with that communication and a bit of it takes a while to invest time to get visibility on all those assets, but when you have a good team of experts, you can actually get visibility on most of the world's assets. Like it's a tractable problem when you go to ground.
Yeah, so I mean, all the work that I've done and I've been involved in for the last few years on portfolio assessments, that's Scope 3 Category 15, explicitly Scope 3 Category 15 investments. So that's not like everything that we produce which relates to Scope 1, 2, and 3 of those investees aren't the bank's Scope 1 or 2. So I can see why it's sometimes confusing in communication, but those are just one category of the banks or the investment managers' Scope 3. And I think they just need to make that clear when they're doing their sort of annual stakeholder reporting.
And one last question over there. Shout out.
All right, thank you. Hello everyone, my name is Jan Kuramush. My question is, we've heard a lot about standards. Aren't we placing too much hope on standards? So what I mean, the point you made, Alex, metrics, what to use, absolute, intensity, denominator. Reasonable people in my view can and will continue to take sides on what's the right metric, and the reason for that is you have different use cases. So it's a bit like hoping, some commission will tell you if zebras are black or white. People will disagree. And more importantly, to your second point, the chart you had, even if we did have these standards, what would follow? If every single company in the world is exactly the same global warming potential, Exxon or Aramco would be just as or as less investable, in my view. In fact, Exxon recently came out last week saying we still don't have standards for measuring our accountants. So isn't there a risk here that we focus a bit too much on standards and not, what we're ultimately hoping the standard will get to, which is action?
Go ahead.
Well, no, I think we need standards. The exact point is that the standards are not well set, so it's not a problem of having a standard or not. I think that's quite straightforward. Yes, we need a standard, but it has to be well built, of course, and has to be enforced as well. Because one problem, like you talk about the GWP, the fact that we have a standard there, the greenhouse gas protocol and actually other reporting protocol as well tell companies that they should use the most recent GWP 100 with the guidelines. It's a standard, but the guidelines is not enforced by law. So the problem is how to make sure that companies follow those standards. So that's the question. I think the question of whether we need a standard or not is an obvious answer. Yes, we need a standard. Otherwise,
Yeah.
Alex?
Yeah, no, I was just going to say, I mean, even if you're just looking at financial accounting standards, just because it's set, it doesn't mean everybody follows the rules and people don't get creative. People are always going to do that kind of thing. So, there is a push, and there's been comments that initiatives like the SASB or the IFRS or the ISSB, it's pushing towards creating this accounting industry-like standards and tracking of progress. But I agree with you. It's very challenging, and it's the responsibility of probably those working in responsible investment to constantly test whether it's doing what it's supposed to be doing, constantly reviewing it. One example of reviewing the actual progress that's being made, even though you might be following standards for things like finance emissions calculations, is there's the recommendations that you should constantly check whether you should be rebalancing your baseline year. If you make significant changes to your portfolio, the year after you set your set your standard, if you suddenly divest, from all of your Russian oil and gas, and you've achieved a great thing, you shouldn't just rest on your laurels. You should take the initiative to then decide, okay, we need to re-baseline our starting year. So, yeah, it's an art and a science, if that was the point. Yeah,
if I could just pick up on that too. We noticed that it's the financial penalties that do more for standardization than the standards themselves. So I've had to put these on a hierarchy, especially with regulation coming up. That seems to be the biggest influence on people aligning to standards. Because if you do spend time as a company doing it, maybe you're looking at the GHG protocol and you're thinking, do I use the operational control method or do I use the ownership method? You can just do both and be ready to report for whatever occasion comes up and give it to the relevant stakeholder as they ask. And so we often find that people disagreeing with the standard is a little bit of there is some good insight there and it's worth unpacking, but to us it's usually an early indicator that the company's not ready for an advanced reporting solution at that stage.
Thank you very much. We are unfortunately out of time. I saw there was another forest of hands. Please connect with all the speakers during the break, but it's time to hand over to Mike. But please join me in thanking the panelists.